Hey investors, many are still parking cash in banks for that steady 5% yield, but a quiet shift is underway toward REITs, SGX-linked tech, and data center plays that could drive higher income today and faster dividend growth over the next decade in Singapore's market. In this video, the plan is to unpack a Singapore-first dividend framework that balances dependable bank income with the growth of tech and digital infrastructure, and then show how to build an allocation that fits CPF and SRS use. This episode is adapted from the latest in-depth Substack deep dive at the Investing Iguana, refined into a clear step-by-step video playbook for local investors. For those new here, this is Iggy, a Singapore-based market analyst who runs the Investing Iguana, focused on SGX dividends, REITs, and tech-driven income strategies for CPF and SRS portfolios. Here's the roadmap today. Following the article structure, the banking dividend reality check, the REIT dividend surge, tech's dividend transformation, the emerging dividend giants, why tech will become Singapore's next dividend powerhouse, the portfolio strategy, and the bottom line with action steps. Let's start with the anchors of most Singapore income portfolios, DBS, OCBC, and UOB, which still deliver dependable income near 5% with quarterly payouts and robust capital buffers. They remain a core sleeve, especially for CPF and SRS-driven investors who want simple execution and reliable distributions. But rates are normalizing, net interest margins are compressing, and loan growth is steady rather than exciting, which caps near-term dividend growth potential even as balance sheets stay strong. In the article, the Big Three Singapore banks dividend snapshot table highlights three things: DPS strength today, forward yields near 5%, and a likely slower pace of increases as the high-rate tailwind fades. So here's the key question for this section. If the dividend engine still runs, but the throttle is no longer wide open, where does the next leg of growth and income come from for Singapore portfolios? Let's use that question to bridge to the next chapter. Income hunters can find higher yields in REITs, led by logistics, industrials, and infrastructure trusts that still trade at attractive yields due to funding costs and cautious sentiment. Cash flows remain resilient because leases are long, tenant quality is high, and rental reversions in certain subsectors are firm, even as financing costs stay elevated. The high-yield REITs yield and quality check table from the article drives three selection rules: prefer staggered debt maturities, target high occupancy, and favor diversified or overseas footprints to reduce concentration risk. If the bank sleeve anchors stability, the REIT sleeve boosts portfolio yield today while maintaining solid cash flow visibility, which is ideal for SRS accounts with long holding periods. Quick recap before we move on. Banks for stability, REITs for higher current yield, and selection matters most at the debt and tenant level. If the full charts, checklists, and the written playbook are needed, grab the Substack post in the description below for the complete breakdown and tables. Singapore's tech and tech-adjacent names have moved into a new phase, where growing free cash flow allows steady dividends and room to lift payouts over time. Think of SGX evolving into a multi-asset market infrastructure platform, ST Engineering blending defense, aerospace, and smart city solutions with long-duration contracts, and Singtel leaning into data centers, 5G, and digital services with active capital recycling. The established SG Tech dividend plays, payout and growth mix table shows lower headline yields than banks today, but stronger dividend growth potential backed by scalable business models and improving operating leverage. For compounding, consider enrolling in DRP or SCRIP where pricing is fair, and place established tech in SRS to capture long-dated growth of distributions. Ask this as the section closes. Is it better to lock a 5% yield that may grow slowly or a 3% yield that can rise each year with scalable platforms and global demand? Next, let's talk about the early stage engines that could become tomorrow's dividend giants. The market often prices these names for uncertainty, but the cash flows are getting stickier as margins scale and contracts lengthen. IFAST is a fee-based wealth platform where AUM growth converts into operating leverage and rising dividends over time, which is the classic dividend growth pattern investors seek. NTT-DC REIT brings regional data center exposure with long-term contracted revenue and inflation mechanics, which helps smooth distributions even through economic cycles. Smaller hardware or software names may pay low or no dividends today, but with improving profitability and clearer capital policies, they can start returning cash in a disciplined way. The emerging dividend candidates, yield today, growth tomorrow table from the article highlights the need for right sizing. Keep positions small, demand recurring revenue, check sponsor quality, and track balance sheet prudence every quarter. Here's the prompt to think about. Would a 1-2% yield now be acceptable if it becomes 4 to 5% in 3 years while the asset base compounds? Let's stack the drivers that make this shift possible next. 4 drivers power this: scalability, regional reach, secular tailwinds, and margin expansion. Scalability means revenue grows faster than fixed costs, so more cash flows to shareholders without heavy balance sheet strain. Regional reach matters because platforms can expand across ASEAN without bank-like capital constraints, accessing a much larger demand pool. Secular tailwinds from cloud, AI, cybersecurity, fintech, and data centers are multi-year, so dividend growth can ride a sustained wave rather than a short cycle. Margin expansion through automation and software mix pushes returns higher even at constant revenue, which is harder for regulated spreads in banking. In the article's Dividend Engines, Banks versus REITs versus Tech comparison, the punchline is clear. Banks anchor stability, REITs lead current yield, and Tech plus digital infra offer the best runway for dividend growth, with improving stability as contracts deepen. So the next step is to assemble the sleeves in a way that serves a Singapore investor's tax and liquidity needs. A practical Singapore allocation goes like this: banks as the core at 40-50%, REITs at 25-30% for higher yield, established tech at 15-20% for dividend growth, and emerging tech at 5-10% for future engines. DBS, OCBC, and UOB anchor income and stability, while an industrial or logistics REIT plus an infrastructure trust raise the overall portfolio yield today. For the growth sleeve, SGX, ST Engineering, Singtel, and Venture aim for dividend CAGR rather than just headline yield, which supports long-run compounding. The emerging sleeve focuses on IFAST and a data center trust first, adding small-cap tech only when a clear capital return policy is in place and profitability is durable. Use SRS to house the REIT and establish tech sleeves if the horizon is long, because tax deferral helps compounding and reduces friction on reinvestment. The article's Sample SGX Dividend Portfolio Blueprint table shows this balance in one view, making yearly rebalancing simple and rules-based. Finally, run the risk checklist. Rate cuts and NIM compression slow bank DPS growth, refinancing risk and debt costs hit REITs, tenant and trade cycles affect ports and logistics, execution and policy shifts impact tech and telco, and valuation risk touches every sleeve. Match each risk to a control, stronger capital, and steady payout for banks, staggered maturities, and fixed-rate debt for REITs, disciplined CapEx and ROIC for tech, diversification across sleeves, and staggered entries with DRP or script to compound. Before the verdict, a quick engagement question. Does your current portfolio lean too hard into one sleeve, and what 2 actions can reduce that concentration this quarter? Keep banks as the income bedrock, but fund the next leg of dividend growth from REITs and tech-driven cash flows tied to logistics, infrastructure, platforms, and data centers. If bank exposure sits above 60%, trim and rotate into one industrial REIT, one infra trust, and one established tech name like SGX or ST Engineering, then seed a small position in IFAST or a data center trust. For CPF, the investable equity scope is limited, so use cash and SRS for the listed sleeves, and stick to a clear rebalancing rule to avoid timing mistakes. The medium-term Singapore policy backdrop is supportive of digital infrastructure and smart city solutions, which helps the dividend growth sleeves, especially in SRS structures. The actionable takeaway is simple: rebalance toward a rising dividend portfolio where banks pay today and tech plus REITs grow tomorrow's check. Would this mix help reach a target income number faster without taking undue single-sleeve risk in the next 5 years? Today's lessons match the article's flow. Banks still anchor stability, REITs lift current yield, tech transforms into dividend growth, emerging names become tomorrow's engines, and a Singapore-first allocation using SRS compounds the whole plan. You can take these lessons into a Singapore investing journey and build a portfolio that pays now and pays more later with clear, rules-based steps. If this was useful, hit like, share it with a friend who loves dividends, and subscribe for weekly Singapore-focused deep dives. For the full charts, checklists, and the written playbook, the Substack link is in the description, and premium members get portfolio blueprints, quarterly rebalances, and priority Q&A. Next up, watch the video on building a Singapore dividend ladder using banks, REITs, and tech payouts across the year for smoother monthly cash flow.